are continuing with our Outlook 2021, Finding Equilibrium. My guest today is considered by many to be the ultimate Washington insider. After starting in Washington at a very young age, he rose the ranks of the Republican Party to become the director of the Office of Management and Budget under President Ronald Reagan. After leaving the White House, he started his career on Wall Street, and today he is the founder of Contra Corners. Please welcome to the show, David Stockman. David, so nice to speak with you after all these years of following your work.
Oh, well, very happy to be on your show. There's a lot to talk about right now.
Oh, yes. Yeah. I want to take a cue from your latest penning, The Mother of All Joyrides, where you write that back on March 24th, the total market cap of global equities dipped to 61.6 trillion on the logical fear that the economic lockdowns would wreak havoc with economic growth, jobs, incomes, and profits. As you say, these fears were correct. And instead of global GDP growth of 4.8% expected last January, the latest survey by PwC projects a 4.0 decline. So my question to you, David, is what are we going up against in 2021?
Well, you know, what I really said in that post yesterday was 2020 was the strangest year in modern history as far as I'm concerned. It should have been a real disaster in the financial markets given what's happened with this COVID pandemic and governments going crazy around the world, locking things down and quarantining the population and, you know, just totally interfering with and disrupting the economies. But instead, we had one of the craziest joyrides in modern times. And what I'm suggesting is joyrides never end well. And so when I look to 2021, I think it's the year after, the morning after. It's what happens when the joyride finally reaches its, peak, and you have the accident thereafter. Now, let me reiterate a point you were making, because I found it striking that a few days ago, the combined market cap of the world equity markets crossed $100 trillion for the first time in history. Not only is that a gigantic number, but more importantly, at the beginning of 2020, before anybody even knew the word COVID, before the Chinese even let on that something disastrous was happening in the public health arena, the market cap of the global market was 80 trillion. So we've gained, notwithstanding all of the economic dislocation and, you know, the deepest recession in history in the second quarter this year, we've had a 25% gain in market cap, 20 trillion from the beginning of the year to the end, even as we exit the year with governments all over the world, from California to New York City to Berlin to Seoul, Korea, locking down their economies again as a result of this flare-up of cases in the last few months. So what you're looking at then is a market that at the beginning of 2020 was expecting $180 per share of S&P 500 earnings. Now, with the year almost over, it looks like at best they'll come in at 120 per share on the S&P 500. So what we have is earnings that have collapsed by 1/3, by 33% from what was expected at the beginning of the year, while at the same time the market's up 25% during that same period. So I call that a joyride, and that's the market side. You know, stuff is valued crazy across the board, but in the post I did yesterday, I couldn't help but coming back to Tesla, because this is really nuts. Tesla a couple of days ago was valued at $600 billion, okay? The entire global auto industry, consisting of real powerhouses like Mercedes and Toyota and the Volkswagen, Audi, Porsche group, and the rest of the lesser players, has a market cap of 600 billion. I mean, that's crazy. The rest of the industry makes 80 or 90 million cars a year. Tesla makes 500,000, and they got equal market caps. Tesla's market cap at 600 billion basically represents about 1,200 times its meager net income, of a few $100 million in the year LTM period just ending. So it's just another example of the joyride, and it's not simply a bubble we're dealing with. The bubble is going to be bad news for all the gamblers and the speculators who, have been riding high and capturing these enormous windfalls, 20 trillion worth in the last year, as we've said. But it's distorting the entire economy of the country and the world because capital is flowing like crazy to these high-flying, massively overvalued companies who are essentially wasting it. As you know, a few days ago, Tesla announced, I think it was on December 8th, $5 billion equity offering. The thing was taken down before the next morning, the market opened. And they've raised, I think, somewhere in the range of 12 billion just in the course of this year and 20 billion from the stock market over the last decade, and they've never made a dime. They've had cumulative losses of $6 billion or so since they went public back in 2009. Now, what this means is capital is being wasted. I mean, it's being diverted. It's being misallocated to these fantastic speculative enterprises. And that's going to drag down the ability of, the economy of Main Street to grow and thrive and prosper in the years ahead. So that's part of the joyride. The other part is governments are totally out of control in terms of the printing press on the monetary side and, the debt accumulation and deficits that they're running on the fiscal side are just out of this world. But I've got one number that I think will help viewers understand how drastically governments have overreacted to the injured economies that they caused with all of their lockdown orders. And, it's really, I call it economic martial law because that's what they've essentially said, ordered people to close their business and shut down commercial activity. But in any event, I've looked at the numbers, and if you look at the level of wage and salary earnings in all of the U.S. as of February. That's on the eve of this whole COVID pandemic and then the lockdowns that happened the next month. If you assume that that was the run rate of wage and salary income, and you project that through October and compare it to what actually happened, because we had 50 million unemployment insurance claims, and the unemployment rate for a few months anyway soared. There's basically been, and this is really important, a $280 billion loss of cumulative wage and salaries over the course of this entire pandemic / lockdown disaster. Now that's from March through October, 280 billion. That's a big number. But guess what? In its wisdom, Washington has passed 4 different bailout bills. So let's just look at it. 4.5 trillion of borrowing and red ink is being pumped into the economy to solve a $280 billion wage shortfall problem. This is nuts. I mean, it's 6 or 7 times more stimulus has been pumped into the economy than we've actually lost, as bad as the shutdowns and lockdowns were in wage and salary loss. Now, why was this possible? It was possible because the Fed printed all the money. They basically monetized the $3 trillion that the federal government has borrowed since March. And when you get in an environment where the Fed is monetizing 100% of the new debt issuance of the cumulative deficit, basically neither fiscal economy or the financial system works. When you borrow that much money, interest rates are supposed to go up. You're supposed to have crowding out. I mean, there's no such thing as a free lunch. And if the federal government's suddenly borrowing, at a 3 or 4 trillion rate rather than 1 trillion or less, interest rates should rise. They didn't, because the Fed and the other central banks stepped in, bought up all the new debt, and put it on their balance sheet based on credit that they snatched from thin air. So that's a terrible thing. That is an enormous distortion. It's taught Washington all the wrong lessons that, that it doesn't matter if you shut down the whole economy. It doesn't matter if you put tens of millions of people out of work. It doesn't matter if you end up destroying 2, 3, 4 million small businesses. You can just borrow the money and hand out, the so-called PPP loans to small business, unemployment insurance to everybody that loses a job or income, and all the rest of the goodies that have been in these, what I call everything bailout bills. You're heading for trouble when you get into that kind of syndrome, and that's exactly where I think everything is leading in 2021. To summarize, a market that's massively overvalued, ridden with speculation, and basically expecting we're going to be back to normal before mid-year, which I think is crazy, and a fiscal and monetary, a bacchanalia, I call it, that is so out of control that governments and central banks have really lost their way. So I can't think that anything good is going to happen in 2021 as all of these chickens come home to roost.
David, an incredible summary there. So, given the fact that there's an incredible divorce and disconnect between equity market capitalizations and reality, really, how does one protect their wealth? I'm assuming you're not in U.S. equities. Is that safe too?
Yeah, I think that's the number one and number two and number three recommendation at the present time. Stay out of the casino. When you have $100 trillion market cap, it's actually 4 times higher than it was at the turn of the century. You have the mother of all bubbles waiting to collapse. Things are so massively overvalued that when the collapse starts, when the bubble bursts, there'll be nothing down below. And this is an important thing. These markets have been totally destroyed in terms of the normal balancing mechanism that keeps things reasonably under control. All the short sellers have been destroyed. They're gone. So normally, when a market begins to go into a deep correction, the short sellers have made a killing. They begin to cover their bets. They become buyers of stock, and that helps to break, the downward adjustment, and eventually the market bottoms and then begins to recover. Well, we've destroyed the short sellers. There are none left. And so therefore, once this market starts to slide south and gains momentum, nobody's going to be covering their bets on the buy side. It'll be a one-way market the wrong way. So that's just one example of what I would call the structural damage that has been done by central banks and this crazy level of stimulus and money printing and balance sheet expansion that has occurred. As the Fed alone expanded its balance sheet 120 billion a month. That's what it's doing right now, 120 billion a month. And they basically are now saying, well, that's going to last into next year or beyond. The ECB is worse. They have announced now that they're going to be buying upwards of 200 billion a month. So just between the two large central banks of the world, they're buying over $250 billion of government paper and other assets a month. They're paying for it out of newly minted liabilities that are snatched right out of thin air. And that's got to be distorting everything.
And David, I guess I'm going to ask you to be a bit of a soothsayer here, but with the incredible money supply, of historic proportions, really, and this Fed-fueled party that we're seeing in equities, wouldn't you think that the Fed would keep this party going a little longer here, and perhaps we wouldn't see the crash in 2021?
Well, it's hard to know. We're in such uncharted waters that the timing of the correction that has to come, and the longer it takes to get there, the more disastrous the crash is going to be. So I can't really put my arms around when that ultimate correction will come. But here's the thing that I believe is fundamentally different from the year 2000, when the Fed bailed everything out in the dot-com crash. or 2007, 2008, when we had the great financial crisis and they pulled more rabbits out of the hat. Let's go back to 2000. The balance sheet of the Fed then was only 500 billion. And it had taken the first 85 years of its existence to get the balance sheet from a starting point of 500 billion. In other words, I call it the Ohio State offense, 3 yards in a cloud of dust in terms of monetary policy. Also, at the time the dot-com crash began in March 2000, the interest rate, the federal funds rate was 6.25. So they had 625 basis points to cut. They ended up cutting it down to 1% for the first time in history. It was considered shocking at the time, but you see, there was enormous dry powder, huge range to cut interest rates, a relatively modest balance sheet that they could expand quite substantially, and they did. Now, you get to 2007, 2008, and we run into our next crisis, the Lehman meltdown in September 2008. By then, the Fed's balance sheet was up to 750 or 800 billion, but still, there was a lot of running room left compared to 7 trillion today. The interest rate, again, had worked its way back up, the funds rate to 5.25. So again, they had 500 basis points to cut. And they had a lot of running room to expand the balance sheet, which of course Bernanke and then Yellen after her and Powell now took great advantage of. So today the balance sheet is 7.2 trillion. It's not, so it's up 10x. Okay. Now my point is, as we look at 2021, there's no interest rate to cut. We're at zero. If we look at the balance sheet, it's 7.2 trillion. They began to normalize it, in 2018 and 2019. They got it down to 3.8 trillion, and then came the market hiccup in September last year, and then the big COVID lockdown disaster in March, and they ran it back up to 7.2 trillion, or by more than 3 trillion in literally a matter of a few months. So my point is, where's the dry powder? What is there left to do? Some guy could say, well, they'll print another 3 trillion, 4 trillion, 5 trillion. I don't think they can, because they've been saying all along that this is not a permanent way of life. This is an emergency. It's one time. It's extraordinary. They've had all these words. At some point, the market is finally going to begin to understand. They have no idea what they're doing. They're just running the printing press like there's no tomorrow. And it's not doing anything for the real economy. I think we're going to be in great trouble with the real economy in the year ahead. And at some point, the disconnect between what I call the Main Street economy, the jobs, the GDP, the investment rate out there, and what we're seeing in the stock indices is finally, going to come unwound.
So David, let's wrap, and that's a very dismal scenario that we have to look forward to in 2021. But what are your safe havens then?
Well, I think it's pretty obvious that the alternative to central bank-driven, stimulus-supported central bank economy is gold. That's the real money in the world. That's the real hard asset that governments and central banks, cannot ultimately depreciate. So I think gold is a safe haven, and it's probably the only safe haven. I don't think bonds are. The bond market, $100 trillion bond market in the world, is an even bigger bubble today than the stock market, if you can imagine that. Why do I believe that? There's 18 trillion of sovereign and corporate credit trading at negative interest rates at the present time. The 10-year US Treasury, which is the fulcrum security of the entire global financial system, is less than 1%, which is less than inflation, which means you can borrow money for 10 years at a negative real cost. This is crazy. This is a sign of a huge bubble. So stay away from stocks, stay away from bonds, begin to accumulate gold, and basically keep your powder dry. Cash will be king when this huge financial market reset finally
Well,
comes.
well said, David. Just one final point, because I need to ask you another question on gold since I've covered that market for more than a decade here. 2020 was obviously the best year ever for the price action for the metal. Many investors are disappointed that it's come back down. Do you see? I mean, what kind of what party do you belong to when we talk gold price? Are you that $5,000 crowd, 10,000, or you're just happy with the status quo right now?
No, I'm happy with the status quo, and I'm very confident it's going to go up. I don't know how much, but a lot, because when confidence in central bank policy and central bank money really begins to evaporate, as the world begins to see the corner that the central banks have painted themselves into, I think there will be a flight to gold. And remember, I think there's only 10 or 12 trillion dollars worth of gold, on the surface of the earth. I mean, that's either traded or in portfolios or in central banks. When you compare that to $100 trillion bond market, $100 trillion stock market, total debt in the world of 270 or 80 trillion at the present, it will not take much movement away from stocks and bonds and other paper securities into gold to have a massive increase. In other words, you got somewhere around 400 trillion worth of stuff that may need a new home, and the home is 10 trillion big. So it doesn't take too much movement out of the stock and bond market into the gold market for a major upward adjustment of price. You have to be invested. I think gold goes up and down. Nothing goes straight up. In the short run, there's all kinds of tactical things that I don't pretend to try to keep up with or even bother with. But I do know that what the central banks of the world have been doing is totally non-sustainable, non-viable. It's a violation of every notion of sound money and stable, sustainable finance that's ever been known to mankind. So that's all you need to know, that central banks are heading into a bad place, and that the world's going to be looking for a safe place to store their wealth.
All right, David Stockman of Contra Corners, fantastic insights. And despite the dismal outlook, I wish you a very happy New Year, David.
Yeah, and you too.
All right, stay safe. And thank you for watching. We'll have much more Outlook coverage for you. So be sure to stay tuned to Stansberry Research. In the meantime, you can follow us on all our social media channels. Thank you for watching. I'm Daniela Cambone.